Free cash flow indicates the company's ability to generate cash to fund its operations, invest in growth, and potentially return value to its shareholders. For investors, analyzing a company's cash flow provides crucial insights into its financial stability and its capacity for future expansion. Within the broader concept of cash flow, there are various metrics that analysts and investors utilize. One such important metric is levered free cash flow. In its simplest form, levered free cash flow is the amount of cash a company has remaining after it has met all of its financial obligations. These obligations encompass not only the day-to-day operating expenses and the necessary reinvestments in the business, but also the payments related to the company's debt. Essentially, levered free cash flow represents the cash that is available to the company's equity holders after all other financial commitments have been fulfilled. It is helpful to contrast levered free cash flow with another related metric known as unlevered free cash flow. While levered free cash flow considers the impact of debt payments, unlevered free cash flow represents the cash flow that would be available to the company before accounting for any debt obligations. Think of unlevered free cash flow as the total cash generated by the company's operations that could potentially be distributed to all investors, both those who hold the company's debt and those who own its equity. On the other hand, levered free cash flow specifically focuses on the cash that remains for the equity shareholders after the debt holders have received their due payments. This distinction is important because it highlights the impact of a company's debt financing decisions on the cash available to its owners. Understanding this fundamental difference between levered and unlevered free cash flow is a crucial first step in appreciating the significance of levered free cash flow in financial analysis. A company might exhibit a strong overall cash-generating ability as indicated by its unlevered free cash flow, but if it has substantial debt obligations, the cash ultimately available to its equity holders, its levered free cash flow, could be considerably lower. This difference underscores the importance of considering a company's debt structure when evaluating its financial health from the perspective of an equity investor. To truly understand how levered free cash flow works, it's important to delve into the specifics of what it represents. As mentioned earlier, levered free cash flow is the residual cash flow that belongs to the equity shareholders after all other financial demands on the company have been met. These demands include the costs of running the business on a daily basis, the investments needed to maintain and grow the business, such as purchasing new equipment or managing inventory, and the payments associated with the company's debt, like interest expenses and the repayment of the principal amount borrowed. To learn more about free cash flow, watch our other videos.